Hi, my name is Christopher Terry, CEO of iMarkets Live, and in this video we are going to discuss the spread, or what is also called the bid-ask. The bid and ask is basically the difference of what a trader wants to buy or sell, or what the market maker is willing to buy or sell the particular asset. In the Forex market, you have spreads depending if you're a large trader, a small trader, if you're trading the US pairs, if you're trading an exotic pair. What I mean by an exotic pair or crosses, for instance, the USD JPY, the GBP USD, the EUR USD. The US based pairs have a tighter spread, and we're going to discuss that in a moment, whereas pairs or crosses from other countries have a wider spread. Now, typically we see, and we'll use the EUR USD, is we will see a spread of 1.5 to 2 pips. And in our last video, we understand what the word pip means. It's percentage in points. The fourth digit, okay, the fourth digit over is the pip, and we discussed that. And what I'm going to do is I'm going to do a little drawing so we all can understand this together. All right, so I'll take out my trusty tool. Let's see here. Okay, so we have the bid, B-I-D, and we have the ask. Now it's different in Forex than it is in futures, and we're going to discuss this also. But we have to establish this. In the Forex market, we have the bid, we have the ask. So let's just take a number, 1.300, okay? So that would be the pip value. Now, if we take a look here, all right, so you see how this looks here, 12228, and then you have the sub pip. So it's the 4 digits. The spread is, let's remove the little sub pip there for a moment, is 3 pips. Now this is when the market is not active, it's closed, and typically it's tighter, okay, when things are active. So we're going to go back to this, and these are the important numbers. So if we have a spread of 2, it would look something like this. The bid actually would be higher in the Forex market. So it would be 1.3001, and the ask would be 1.3002. Okay, so the ask is always higher than the bid. So when they say let the bid come to you or offer it out, that's what that means. Now in the Forex market, you buy the ask. You buy the ask and you sell the bid. All right, so you're always buying the higher price. So the spread here is equivalent of 1 pip as demonstration, for demonstration purposes. The bid is 0.1, the ask is 0.2. So if you wanted to buy this in the Forex market, you would buy the ask. You would buy the higher price. So typically we have a 2 pip spread on average, depending on the broker, depending on your size of volume. Some brokers have a 1 pip spread plus commissions. Okay, so every broker is different, but standard in the industry, let's just use 2 pips for the spread, and that includes a commission. So I'm going to discuss the futures and Forex and what that means. So let's just say you want to buy 1 standard contract, standard, right? And you pay, make this 0.3, you pay a 2 pip spread. You now paid $12.50, I mean $10, right? Per pip times 2, you're in the trade and you're down 20 bucks because you bought one contract and you bought it a two pip spread. You bought it the high price. If you want to sell it, you would sell at the low price. All right, so the commissions and everything, the spread is included the one time. So your total cost to go into a trade would be 20 bucks. The bid and ask, this is what the market maker would like to sell it to you and buy it back for. Same thing if you go to a currency exchange. Let me see if I could find an example. Okay, just real quick. You could see here, this is just a picture on the internet. And you could see here one price and another price. That's the bid, that's the ask. No matter where you look at, they buy and they sell. They buy at lower prices, they sell at higher prices. And these are all these money exchanges. Okay, let's go back to the charts. Okay, so in the Forex market, in the Forex spot market, we know that the bid and ask is, the bid is always lower, the ask is always higher. But when you buy and sell, you buy the higher price, the ask, you sell the lower price. You're always doing what is called going to the market and just paying the higher price always. That the commissions are always built in. So let's now go and let me erase this. All right. All right, so just I'm going to erase all this jibber jabber. Okay, we are now looking at the Forex futures market. The Forex futures market is different. Typically, you will have a 1 pip spread plus the commissions. Now I'm going to show you what that looks like. All right, same situation. We have the ask and we have the bid. The ask is 1.3001 and the bid is 0, 0. So you have a 1 pip spread. Typically, this is how it looks like in the futures market. Now, there's two ways to trade and two ways to enter in the futures market for Forex. You could offer, which means you put a limit, which means you want a certain price. So let's just say you want to sell at point 0.3001. You put a limit out there, and when the price comes up to it, you are now selling the market. You're selling short, for example. You have a 1 pip spread. In the Forex market, you're buying, again, you're buying up here. In the futures market, you can put a limit and sell this. You can sell the offer. The other thing is, if you just want to go to the market and sell the Forex futures market, you would sell at the bid. Okay, you would sell at the bid. You would give away that 1 pip and you would sell at the bid. The difference in the Forex spot market, the Forex futures market for the standard contract is that in the spot market, it's $10 per pip. In the futures market, it's $12.50 per pip. All right. The difference in the spot market, as we said earlier, is the bid and ask. Roughly, let's just say it's $20. All right. Let's just say it's $20 for the spread, and when you get in a trade, you're down 20 bucks because you're giving away the 2 pips plus includes the commissions. In the futures market, let's just say you went to the market and you sold it. So initially, that spread, it's $12.50, right? So let's just say you bought, you sold, and you did it both at the markets. You gave away $25 in spread when you buy and sell, plus the commissions, okay, like $3 or $4 completely for a round term. So sometimes, depending on how you trade it, you can actually cost you more in the futures market. If you were to put a limit out and you sell the offer and you eliminate the spread, you have a zero spread on the entry, and let's just say you have you bid and get your price, you have a zero spread on the exit, you're only paying a commission, which is around $4, a round turn, in and out, $2 on each side. So the bid and ask is what somebody's willing to buy or sell at that particular time. And the futures market, the same thing. The futures for the S&P futures, which is this. Okay, I just want to show you. The same thing. It has a one tick spread where, for instance, if we're looking at this market as it is, it would be 2063.75 bid, 2064 even offer. And the same thing, you could buy at the market, which means you're buying at the higher price, or you could bid to buy at 0.75. So essentially, the futures market give you the luxury of buying on a limit, which is the price you want, or entering at the market, which you are giving away that spread. The Forex spot market, you have no choice but to pay for the spread, and that's the way it is. Now, in the Forex spot market, depending on your volume, if you're a very large trader, you get very tight spreads. If you're a small trader, you pay more of a retail price, depending on the broker also. I know there's some brokers, one of the brokers that we suggest, and it's the only broker we suggest because it's FXCM. It's a New York Stock Exchange listed company. They're safe. They have a new program that came out. It's a very tight spread. So they've kind of tightened the game or leveled the playing field against the futures because the futures have been gaining momentum against them. So you could look into that. But other than that, the bid and ask is basically the difference in price. That's all it is. It's what somebody's willing to pay to sell it or pay to buy it. And now you know what the bid and ask is. The next video, we are going to discuss contract sizes or lot sizes.